The stock market is holding its breath as the Fed works tirelessly to achieve a soft landing for the U.S. economy. The Fed's Chair Jay Powell's recent testimony has only added to the excitement and speculation, fueling expectations of a bigger interest rate hike this month and sending traders into a frenzy. The markets are already reacting, with Treasury traders doubling down on recession expectations and the dollar rebounding while equity markets are giving up gains. It's clear that the stakes are high, and the Fed's delicate balancing act is being watched by investors and traders with bated breath. However, history shows that achieving a soft landing is no easy feat over the past 50 years. The Fed has only succeeded twice and failed 6 times. Let's explore what happened in those past attempts and try to understand what might be in store for us now. In 1973, Arthur Burns, the chair of the Federal Reserve back then, predicted that the U.S. economy was headed for a soft landing. However, this prediction turned out to be wrong, as the U.S. economy did experience a recession in 1973 to 1975. The soft landing prediction was based on several factors, including the Fed's decision to raise interest rates to slow down inflation and prevent overheating of the economy. Burns believed that the economy could handle the interest rate increases without going into a full-blown recession. However, the oil crisis of 1973, which was triggered by the Arab-Israeli War, had a major impact on the U.S. economy. The price of oil quadrupled, leading to high inflation and reduced economic growth. The crisis also led to a stock market crash and increased unemployment. The combination of the oil crisis, high inflation, and rising unemployment resulted in a severe recession that lasted for almost 2 years. The U.S. economy shrank by 3.2% in 1974, and another 0.5% in 1975. Dow Jones Industrial lost almost half of its value, dropping from a high of around 1050 in early 1973 to a low of around 577 inches late 1974. The recession and the oil crisis triggered a wave of bankruptcies and financial distress among many companies, which further undermined investor confidence. Over the past 50 years, only twice did the Fed predict a successful soft landing. In 1984, the Fed again tried to engineer a soft landing for the U.S. economy, and this time the prediction turned out to be correct. The 1984 soft landing was achieved through a combination of factors. First, Fed under the leadership of Chairman Paul Volcker took a gradual approach to raising interest rates. Second, the global economy was in a relatively stable period, with no major external shocks to disrupt the U.S. economy's growth. The soft landing was evident in the U.S. economic data. For example, in 1984, the U.S. economy grew by 7.3%, one of the fastest rates of growth in the post-World War II era. However, the economy slowed down in 1985, with growth slowing to 4.2%. Which was still strong but not as fast as the previous year. This slower growth was in line with the Fed's soft landing prediction, which aimed to prevent the economy from overheating and avoid a recession. In 1995, the U.S. economy experienced another successful soft landing. The Fed, led by Chairman Alan Greenspan, sought to slow down the pace of economic growth and prevent inflation from rising too quickly. To achieve this goal, the Fed took a different approach than in previous cycles. Instead of raising interest rates, the Fed kept rates relatively low and focused on using other tools to manage the economy. One of the key tools used by the Fed in 1995 was forward guidance. This involved communicating the Fed's policy intentions to the market in advance. The Fed kept interest rates relatively low during the period, with the federal funds rate hovering around 6% for much of 1995. Yes, you are not hearing it wrong, 6% peak rate wasn't that high in past standard. But the soft landing of the 1995 may have been the result of good fortune, not good management. In 1994, the demographics of the U.S. were favorable for disinflation. The baby boomer generation was at its most productive age and technology advancements boosted productivity. Immigration was active and the labor force and real productivity grew at more than 1% and 2% respectively. These factors allowed for robust growth without pressure on inflation. During the 1995 soft landing, the S&P 500 performed well, with the index rising by around 34% over the course of the year. This reflected the overall strength of the U.S. economy and the positive market sentiment at the time. If we look back at the past 50 years, the Fed has attempted to engineer a soft landing on several occasions, but only 2 of these attempts were successful, in 1984 and 1995. The other 6 attempts resulted in failed predictions. Here are some examples. 1968, the Fed attempted to engineer a soft landing by raising interest rates gradually to slow down inflation. However, the policy was too late to prevent a recession, which started in December 1969 and lasted for 11 months. 1973, as we discussed earlier, the Fed attempted another soft landing by raising interest rates to control inflation. However, the oil crisis and other external factors led to a recession that lasted for 16 months. 1981, also called Reagan's Recession, the Fed raised interest rates to combat inflation, which resulted in a severe recession that lasted for 16 months. The recession was the worst since the Great Depression, with unemployment peaking at 10.8%. 1990, the Fed attempted to engineer a soft landing by gradually raising interest rates to control inflation. However, a slowdown in the housing market and the Gulf War led to a recession that lasted for 8 months. 2001, the Fed cut interest rates aggressively to stimulate economic growth, but the 9/11 attacks and the bursting of the dot-com bubble led to a recession that lasted for 8 months. 2007, the Fed attempted to engineer a soft landing by gradually raising interest rates to control inflation. However, the subprime mortgage crisis and the collapse of the housing market led to the Great Recession, which was the worst economic downturn since the Great Depression. March 7, Fed Chairman Jay Powell acknowledged that high inflation is causing significant hardship and that the Fed is committed to returning inflation to their 2% goal. Despite some moderation, inflation remains above the FOMC's longer-run objective of 2%. Powell noted that the labor market remains tight, with unemployment rates at their lowest level since 1969. And that the Fed has continued to tighten its monetary policy stance by raising interest rates by 4.5 percentage points over the past year. The Fed anticipates that ongoing increases in the target range for the federal funds rate will be necessary to achieve a sufficiently restrictive monetary policy stance to return inflation to 2% over time. However, Powell warned that the process of getting inflation back down to 2% will be bumpy and require sustained efforts. The distinction between a soft landing and a hard landing can be very difficult to determine, especially in the early stages of a recession. This is because the initial signs of a soft landing can often be similar to those of a hard landing. For example, in both cases, interest rate hikes may reach a peak, and the market may begin pricing in future rate cuts. Additionally, the stock market may rebound, giving a false sense of security. Currently, the U.S. economy is facing unique challenges that make it even harder to predict whether a soft landing is possible. One historical indicator that is causing concern is the 2 to 10-year yield curve inversion, which has occurred 9 times in the past 100 years. The previous 8 occurrences were all followed by a recession, and now we are experiencing the 9th. This is a bad sign for the economy. Given these challenges and indicators, it's too soon to tell whether a soft landing is achievable this time around. It's important for investors and policymakers to remain vigilant and keep a close eye on economic data to better understand the true state of the economy and make informed decisions.